The U.S. putting a trade war with China on hold for now, suspending plans to impose tariffs on up to $150 billion in Chinese products. Joining us now, Jonas Ferris, MaxFunds.com co-founder and an FBN contributor, and Art Hogan, chief market strategist at B. Riley FBR. Good morning to you both. Jonas, I'll start with you. The Treasury Secretary, Mnuchin, saying, hey, he's got the framework of a deal with China and is putting the trade war on hold. His words for now. How significant is this, and what does it mean for markets and the economy? By the way, I want you to hear this sound from Mnuchin first. Listen.
I'm pleased to report that we've made very meaningful progress, and we agreed on a framework, which is important to understand. And the framework includes their agreement to substantially reduce the trade deficit by increasing their purchases of goods.
Jonas, what does it mean for markets and the economy?
Well, it's good for, in the short run at least, stocks and bonds, because that was what a fear. Investors don't want a trade war with China. That doesn't mean it's good policy to back away and fold easy and kind of give up on this game of chicken we're playing with China. But we also investors don't want tariffs. They don't want China, importantly, backing off bond purchases as we're borrowing more and more money. So it's possible that looks like we're, if not folding, not going to be as aggressive as we could be. Now, in a few days, this could change with tariff. This is just a temporary situation, but it seemed to be getting more aggressive, and now it's seeming to be getting less likely that there's going to be
just a little
trouble.
bit. Yeah, interesting. Art, to you, it seems like we had mixed messages over the weekend from the administration as the U.S. trade rep Lighthizer saying that tariffs are still an important tool. So will these mixed signals constrain any stock market upside? We've got the Dow up over 200 points. That's the indication for the open. But what will it mean for traders? How will they view these conflicting stories?
Well, I can tell you this. The biggest thing that's gotten in the way of this market moving forward is fear of a trade mistake or a trade policy mistake. So any modicum of good news that we get, any sense that we get that we're actually negotiating and not just, going about this in a hand-me-handed fashion is going to be a positive for this market. When you look at what the market's done with a first quarter earnings season that was nothing short of spectacular and really not moved whatsoever, I think we're just in constant fear that we're going to make a huge mistake on trade. This feels like we're getting to a better place on trade, and I think the market's going to celebrate that.
Wow. Okay. So moving on to another topic now, Jonas, for the first time in nearly 20 years, 18 years, the 10-year yield, the yield on the Treasury, is above that from bonds from 7 major developed countries. What does that mean? Are we no longer the safe haven? What should we read into this?
It could be good, it could be bad. I mean, I think it's a little suspicious that the week we were going to just go to China, and all of a sudden interest rates go above 3% for our government bonds, and we're like, oh, okay, we're not going to mess around with China. I think there's something fishy going on there. That said, we're borrowing at a much higher rate than other. 3% is not a lot, 3.1, but it is compared to what France or Germany or all the other major economies borrow at. Now, that said, the positive is your emerging markets borrow at much higher money because they have higher interest rates and higher growth. You want higher growth and higher inflation, higher rates. So if we are somewhere between a debt economy, look, if borrowing at low rates was good, then Japan would have the best economy the last 30 years. The bottom line is you want to have growth. We have growth now faster than those economies, so our government has to pay more. The negative is it's because investors are concerned we are borrowing too much. We are cutting taxes, raising spending. Someone's got to finance that. That means we're borrowing more. They got to pay more. We have to reward them for that. So there's a negative and a positive in this.
Yeah, the government definitely borrowing more. That last budget really broke the boundaries, I think. On to yet another topic this morning, Maduro winning the election in Venezuela, all eyes on that. And, of course, it's no surprise that he won, but it's a real loss for the Venezuelan people as that economy on the brink of collapse. Oil prices are already up about 0.33% this morning, 71.55. Where does oil go from here, and what is the broader market and economic impacts?
Yeah, it's interesting. Venezuela really largely not talked about in the overall supply and demand in the global energy market, only because their supply has been depleting over the last 5 years. It's amazing how little they've put into their oil infrastructure and how little the amount of capex that's really gone on there. So when we think about the energy market in general, I think we've gotten to we're in balance sooner than the market thought we would. In the first quarter of this year, the global supply and demand balance is there. What now is in the market is a fear of disruption of supply, much less from Venezuela and much more from somewhere in the Middle East, and as things heat up in Iran.
Art, lots going on. Jonas, thanks to you both for coming on today. Lots affecting those markets, but it all seems to be pretty positive so far. Jonas and Art, thank you.